Okay, the final part of Chapter 4 and the final official financial statement we're going to look at is the statement of cash flows. And obviously, the purpose of the statement of cash flows is to reconcile changes in cash. And what we want to do with the statement of cash flows is break items down into three major classifications of cash to make it a little bit more useful rather than just how did cash change. So we look at cash flow from operating activities, the cash flows that arise from investing activities, and those that arise from financing activities. And as you might imagine, each activity implies a different origin. Each activity correlates to a division of a firm's life cycle. So when you're operating, that is the major component of how you do business, your sales, maybe you're selling a product, you're offering a service, whatever generates your consistent revenue streams over time. Whereas investing activities refer to those activities that you use to increase the capital of your firm by investing in machinery, investing in buildings, investing in long-term assets and patents and so forth. And financing activities dictate, how do you raise your money? How do you finance the operations of your firm? How do you finance the investing activities of your firm? And so it's a sort of big life cycle where you finance, then you invest, and then you operate, and then you invest more, and then sometimes you'll get back into financing and kind of go through those over and over again to grow a firm and to increase your profit margins. Before this, we talked a lot about accrual accounting and net income being the primary driver of market activity, EPS reports, analysts forecasting EPS and net income. Then why do we care about cash flows, right? Why don't, if we're so bent on accrual accounting and that's what net income is, then why any interest in the statement of cash flows? Well, obviously, companies can't pay their bills with accounting earnings. And if accrual earnings, that is net income, earnings that are made up of deferrals and accruals, aren't backed by cash flow in a short term, then they aren't really that great. So, we could book revenues all day, but if we don't receive cash that correlates to those revenues over time, then we are going to not have a sustainable revenue stream that actually manifests itself into anything useful. So what are the four main issues that the SCF helps with in helping our users assess the firm's ability to generate future cash flows? Is one of the main models of the statement. It helps predict our timing, the uncertainty, the amount of future cash flows. Determining stock prices, this is a big deal. The discounted cash flow valuation models, a model in finance that is used to determine to some degree stock prices and the value of a firm's securities. Liquidity, right? Since cash is the most liquid asset, this is also something that's high on the minds of financial statement users. How liquid is their firm? Are they going to be able to pay short-term debts and obligations? Then kind of dovetailing obviously into that, the firm's ability to pay dividends and meet obligations. Again, accrual earnings, which are net income, right? Net income is a very accrual-based number. It does have some cash components, but it is largely an accrual-based number. We can't pay our bills in a promise of cash in the future, right? We can't satisfy a dividend requirement with them. Another big one is to examine the relationship between net income and cash flow from operations. So that's the sort of tie-in from the income statement to the statement of cash flows, is that net income is a result of operations that have occurred in the firm, and this is tightly wedded to our cash flows from operations. If you think about it, net income is not going to be a result of your investing activities or your financing activities. It's going to be a result of your operating activities. Financial statement users, in this case, can benefit from knowing whether and why net income and operating cash flows differ over a period of time. Because if we are responsibly determining revenues and expenses, based on the matching principle and the revenue recognition principle, and we're not just making these expenses and revenues up, then they should be highly correlated with cash flows from operating activities over time. If earnings are not converted into cash on a timely basis, then the quality of the reported income is thought to be low, everything else equal. So, if you have a graph and, over time, this is say our cash flow, say our net income is going this way and our cash flow is here, then if this is over, a period of years, then why are we booking more net income when we aren't recognizing any cash coming in from our operating activities? Also, we want to understand how the firm is financing its investing activities, what money it's pouring into that operation. Investing activities are sometimes called capital expenditures, and we get a good sense of what's going on there. Also, we want to know how a firm's receiving its financing, how much did it borrow during the period, whether it paid any dividends, whether it used cash to repurchase stock or buy new equipment. And so it tells us a lot about how the firm is using their cash. Also, it is valuable in determining where cash came from. So if we get a big windfall of cash, is it due to a debt issue? Well, if it's due to a debt issue, that's great, but it's not really that good because we had to go and borrow this money. We're going to have to pay it back. Whereas if it came from increased sales, that is operating cash flows, hey, that's a lot better because we're sustaining our own cash flow. We're not having to depend on creditors for that amount of money. Okay, so it is a very important financial statement for us to look at in order to determine how the company's strategically using its cash, and also kind of, in some ways, very much the long-term profitability of the company. Okay, so what do we need to prepare a statement of cash flows? And I will sort of footnote this. What do we need to prepare a statement of cash flow by the indirect method? And there's two methods. We'll talk about that in a second. There's two methods to constructing a statement of cash flows. There's the direct and the indirect method. The indirect method is used by about 99% of companies. And again, we'll talk about why, but this is why we will focus on the indirect method and not really pay a lot of attention to the direct method. Also, the indirect method is more difficult to create from a financial statement preparation standpoint. So again, remember the sections correlate to our corporate activities, the kind of big stages of a corporation over its operating cycle: financing activities, investing activities, operating activities. The operating activities are going to be just the activities that earn profit in a company. So they're typically derived from net income, current assets, and current liabilities. And this section can be calculated with a direct or indirect approach. The other two sections don't vary based on whether you use a direct or indirect. They're calculated exactly the same. There's only one way to calculate them. Investing activities relate to changes in investments, long-term assets. That includes, of course, PP&E, long-term investments, that's what the investments would be, and also intangible assets. Cash flows from financing activities tend to focus on long-term debt and equity and include changes to dividends payable and notes payable. Also, this is short-term notes payable. And also, up here in investing activities, it includes short-term notes receivable. Okay, so there are exceptions to this rule. Dividends payable, short-term notes payable, these are both current liabilities. And you would think they would be in operating activities since most current liabilities are, but these are the exceptions to the rule. You can kind of cleverly map a balance sheet in terms of where everything goes into by kind of lopping it off in these different regions. We have if you put all the assets on the left-hand side of the balance sheet, all of the liabilities and equity pieces on the other side, then you have something that draws up this sort of a schematic where your current assets, your current liabilities are all cash flow from operating activities. Your long-term investments, your PP&E, and your patents are all going to be cash flow from investing activities. And remember, these are exceptions. These are the common exceptions that belong in cash flows from financing activities, even though they are current liabilities. And then we have the equity pieces and the long-term debt, which are also part of financing activities. So again, we have this idea that we can either do a direct or an indirect method, and that, again, only affects cash flow from operating activities or cash flows from operations. Either method will result in the same net cash flow. CFI and CFS are the same under either method, and under either method, the following will hold true: that cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, when you combine all these, they will equal the total change in cash for the period. And by that I mean the change on the balance sheet, right? And it's also important to recognize that we include cash equivalents as cash in the statement of cash flows. Remember, cash equivalents are those extremely highly liquid less than 3 month investments. Investments that don't have a lot of time to change because of interest rate fluctuations. The direct format of the statement of cash flows is calculated by simply adding and subtracting specific cash receipts and disbursements that have to do with operations. So we would have cash from sales, and that would be an inflow of cash. We would subtract off any cash used to pay for inventory, add cash that we collected from our accounts receivable, subtract any cash used to pay payables or bills, and we would separately highlight each item, and that's how you would directly solve for the cash flow from operations. If the firm uses a direct format, then it has to provide a reconciliation of the net income number to cash flow, which is what the indirect format does. And so a vast majority of companies just use the indirect format. They do it because if they do the direct, they have to do an indirect anyway. And also a lot of companies feel that the direct format has a bit too much information that it turns over about the sources and uses of cash in the cash flow from operations. So they feel like there's a bit of proprietary information. The indirect format, again, it's using net income to derive cash flow from operating activities. So we start at a number that has a lot of accrual information in it. And then we strip out the accrual information, that is any revenues or any expenses that we recognized that did not have an exchange of cash during the period we're reporting for, right? Because remember, there's accruals, and accruals are those instances where we recognize expenses or revenues prior to the receipt of cash. And deferrals are those items where we receive cash prior to recognizing the expense or revenue, okay? So remember, the accrual accounting method allows us to recognize revenues and expenses independent of cash. Therefore, there's some of that in this net income number, and if cash wasn't exchanged during the period, then it's not going to have anything to do with our cash flow from operating activities during that period. So we're using net income as a starting point. And remember, we're recognizing, what do? We want to get rid of revenues and expenses we've recognized in this period for which cash was received or paid in the past, right? Remember the cash event, then we had the recognition event. That is a deferral. We want to get rid of those. Revenues and expenses we've recognized in this period for which cash was received or paid in this period. So this is where cash and the recognition event coincide. Now, they don't have to coincide at the same time. They just have to coincide during some time of the period that we're trying to report for. And then finally, we have the recognition event, then the cash event. And that's an accrual where we recognize revenues and expenses in this period, but cash is not going to be paid or received until later. And so we get rid of this, we get rid of those, and then all we're left with is the one where the cash and the recognition are equal, they happen at the same time. Well, then we have cash accounting, right? Some of the idea here is that net income is going to be a linear equation of some cash we received in the past, some cash flows that we're receiving this period, and some cash flows that we might be receiving in a future period. This was a deferral. This one is the accrual. And this one is the cash that we actually want to recognize during time period T. So we back out those accruals and deferrals, and that'll leave us a number which just represents the revenues and expenses that generated cash during this period. We will look at the indirect method for cash flow from operating activities in much more detail in the next module. This is just sort of to give you a basis for the concept of what's going on. Don't ignore it, because the more you can explain this to yourself, the less it'll become like a memorization process to determine cash flows.